Okay, it is the end of 2025. We're approaching it at least, and we're going to get a market recap of the year and get a look ahead on what our next guest is watching for in 2026. We're joined by Jerome Hass, partner at Lightwater Partners. It's good to have you this morning, sir. Thanks for taking the time.
Thanks for having me.
So let's take a look at the markets first of all today. What do you make of the markets? Are we seeing a kind of a downward turn because of some data coming out this week that we're waiting for?
Well, I'd say the markets are largely flat this morning, and what they're waiting for is the long-awaited data because of the U.S. shutdown. We didn't have U.S. labor data for quite a few weeks, and so the market's eagerly anticipating that. So I don't anticipate too much will happen today until data comes out tomorrow morning.
Yeah, and potentially some movement tomorrow. Do you think that'll affect the TSX as well?
Yeah, of course it will. We seem to, we always look to see what Big Brother's doing south of the border, and that definitely has an impact on our markets. But we did have some positive inflation data out in Canada today, and I think it bodes well for future cuts in Canada for next year.
Yeah, I was going to ask you, like that data that we saw coming out today where inflation kind of held steady at 2.2%. How is that affecting the TSX and the markets today? And then you mentioned next year, like how will that affect them heading into the new year?
Well, I think that the Bank of Canada held last week because it's concerned still about inflation, and there was really no incentive on their part to get ahead of things. Now that we've seen another mark of inflation at reasonable levels, and the core inflation was actually below the target, I think it was less than the 2.2, so that's good news for potential cuts, and I think it just increases the possibility of further cuts in 2026.
Okay, we're also seeing another tech slide today. We've been seeing this for a couple of weeks now. The tech stocks not doing as well as they have been for majority of this year. Do you foresee that any kind of a rebound there for tech stocks before the end of the year?
Well, I do believe we'll see a Santa Claus rally. So 80% of the time we get one before the end of the year. So the chances are in favor of that. That being said, we are not very bullish on the tech sector, especially U.S. techs, the mega techs. In fact, we have a short position on the Magnificent Seven. We just think the hype and the valuations are just through the roof, and so much money has flowed into them that it's just inevitable that when that flow stops, they will pull back and continue to pull back to much lower levels.
You say there's still plenty of opportunities in the Canadian mid-cap space, and you have two suggestions in terms of what you think investors should be looking at. I wonder if you want to go through those. If you want to start with the first one, described of the Bloomberg of trade. Yeah,
well, Bloomberg is a long-term holding for us, and they really are the Bloomberg of trade. They are the standard for international trade and commerce. And if you're an airline, you're a freight forwarder, you're a trucking company, you absolutely have to use Descartes and Descartes software. And so that's what we really like about the business. The other is it has very high recurring revenues. So the former CEO always used to say, on the first day of a quarter, I know where 90% of my revenues are coming, and I spend the next 90 days looking for the next 10%. We just love that consistency of its business model. Unfortunately, it's been taken out to the woodshed this year. Up until they released their results at the beginning of December, stock was down about 32% at its lows, and it was largely fears of AI impacting the business, as well as the Trump tariffs, because they're so dependent upon trade. And what really changed it, and it showed how the street had got this one completely wrong, was the Q3 numbers, which came out in the beginning of December. And they had organic growth of 7%, well above what anybody was looking for. It showed the resilience of their business model, and the stock jumped 14% that day, which just showed how wrong the street had got this stock for this year.
Interesting. Okay, and your other pick is GoEasy Financial. Tell us about this, why you like this one.
Yeah, well, it's a stock that, again, has been suffering this year. They've had a number of issues. Most recently, their new CEO had to resign for health reasons. There was a short report in September 22nd, which pulled the shares down. And then the market wasn't too impressed with the Q3 numbers, in which they took an additional $12 million provision. But what's interesting about GoEasy is that it's traded off on fears of recession in Canada, but at the same time, our banks are trading at all-time highs. You know, you look at all of the banks that were trading about 14 times PE, and GoEasy is trading about 6.5 times next year's earnings. And on top of that, when you think back 6 quarters, GoEasy and Royal Bank, and I'm just picking that name out of the blue, but it's probably the highest rated of the Canadian banks, they were actually trading at the same valuation multiple. Now fast forward, we've got Royal Bank trading at 14 times PE, and you've got GoEasy at 6.5 times. That's the widest differential that's ever existed between the two. And as a consequence, we happen to think GoEasy is attractive at these levels. You know, you got Royal Bank that's hopefully going to grow at 7% next year if they meet analyst expectations, where even on reduced number, GoEasy is looking to grow 25% next year. I'd rather own GoEasy at 6.5 times than Royal Bank at 14 times and 7% growth.
Wow. You talk about some of these Canadian companies and how they tend to be underfollowed and undervalued. I know you went through kind of some of the reasons why GoEasy is in that situation, but why do you think there are some of these companies that are just underfollowed, undervalued in Canada?
Well, number one is our pension funds don't invest in Canada, and so there's a trickle-down effect from that. And the second is the concentration amongst the big 6 banks and the brokerage houses and their wealth arms. They essentially do not invest in mid-cap and small-cap stocks anymore. So, you know, 20 years ago, if you found an interesting stock, you'd usually get in ahead of the large funds, and then eventually they would come in and buy it and drive the stock off, and we would recycle our capital and move on. Nowadays, nobody comes in and buys those names. So you get these wide differentials between mid caps and large caps in Canada. And when you think about it, we're effectively, as a nation, putting our money in the oligopolies and the monopolies, which are the big 6 banks. We're putting it into the utilities. We're putting it into the telecoms. The grocery stores, all the oligopolies and monopolies, and you know, it affects our productivity in this country because we're not deploying capital in the most efficient way we could.
Very interesting. Okay, Jerome Hass, partner at Lightwater Partners. It's good to have you on today. Thanks so much for taking the time.